In the last two videos, we looked at two different money machines. First, private debt. That is where high street banks create new bank account money when they lend, a deposit appears, a buyer gets a house, a seller gets paid, and a borrower gets 30 years of payments wrapped around their neck. Then we looked at public debt, the national debt. Not a giant household credit card, but a giant web of government promises. The government borrows by issuing gilts. Investors hold those gilts as assets. And the real question is not just how much did Britain borrow, it is what did Britain get for it? But there is a third machine, and this is the one people usually mean when they shout money printing. Because sometimes in a crisis, the Bank of England creates money digitally. Not notes, not coins, not a wheelbarrow of cash being pushed through Westminster, but central bank reserves. Which sounds boring, and that is how you know it's important. Because in economics, the most powerful things are usually given names that make normal people fall asleep before they realise they're being mugged. So what are central bank reserves? Let's start with something simple. If you buy a sandwich, you tap your card, your bank account goes down £4, the sandwich shop's account goes up £4. From your point of view, that is the whole story. You have less money, the sandwich shop has more money. You have a sandwich that somehow costs more than a meal used to be. But behind the scenes, something else has to happen. Because maybe your account is with Lloyds, and the sandwich shop's account is with Barclays. So Lloyds cannot just write -£4 in its own notebook and hope Barclays believes it. The banks have to settle up. And one of the safest ways to do that is using money held at the Bank of England. That money is called reserves. A reserve is basically a bank's bank account at the central bank. You and I do not have reserve accounts. Your local plumber does not have one. The corner shop does not have one. But commercial banks do. So when banks need to settle payments with each other, reserves are the final money behind the scenes. They are not the same as money in your current account. Your bank balance is commercial bank money. A bank's reserve balance is central bank money. And that difference matters, because in our video where we talked about private banks, we said they create deposits when they lend, but the Bank of England creates reserves. It creates the money banks use with each other. So now we have three layers. At the top, you have physical cash, notes and coins. That is the money people picture. In the middle, you have bank deposits, i.e. the numbers in your account. That is the money people actually use. And underneath, you have reserves, the money banks use to settle with each other. That is money most people never see. And because it is plumbing, nobody thinks about it until something blocks. Now, most of the time, the Bank of England influences the economy mainly through interest rates. That affects borrowing costs. Mortgages get cheaper or more expensive. Business loans get cheaper or more expensive. Savings rates move. Asset prices react. People spend more, spend less, borrow more, borrow less. That is the normal steering wheel. But sometimes the economy hits a wall. After the financial crisis, during the pandemic, during periods where interest rates are already extremely low and the system still looks frozen, at that point the Bank of England reaches for a different tool, quantitative easing, or QE, which is an impressively dull phrase for something that can move hundreds of billions of pounds. The simple version is this: the Bank of England creates new central bank reserves. It uses those reserves to buy financial assets, mostly government bonds called gilts, from investors like pension funds and insurance companies. Those investors now have money instead of gilts. The Bank of England now has gilts. And the banking system now has more reserves. No tax was collected first. No saver had to deposit the money first. The bank did not find it down the back of the national sofa. It created central bank money electronically. This is the part where people start shouting because it sounds like free money. And if the Bank of England could just create money to buy government bonds, the obvious question is, why not just do it all the time? Why not print enough to fix the NHS? Why not print enough to build houses? Why not print enough to give everyone a pay rise? Why not print enough so nobody ever has to look at a council tax bill and briefly consider living in the woods? The answer is because creating money is not the same as creating real wealth. Money can be created quickly. Hospitals cannot. Doctors cannot. Houses cannot. Energy systems cannot. If you create money but not more real stuff, eventually you do not make everyone richer. You just give everyone more claims on the same limited pile of things. And when too much money chases too few goods, services, homes, workers or resources, prices rise. That is the danger. But quantitative easing is not quite the cartoon people imagine. It is not usually the Bank of England printing cash and handing it directly to ordinary people. It is more like an asset swap. The bank buys gilts from financial investors. Those investors swap one asset with another. Before quantitative easing, they had a gilt. After quantitative easing, they hold money. And because holding that money earns less, they may go looking for somewhere else to put it. Corporate bonds, shares, property funds, other financial assets. That is partly the point. Quantitative easing is meant to push down longer-term interest rates, support financial markets, encourage lending, and stop the economy seizing up. In a crisis, that can be useful. If everyone panics at once, markets can freeze, banks get nervous, investors stop buying, businesses cannot raise money, households cut back, asset prices fall, confidence disappears. Quantitative easing can act like a giant emergency pump. It pushes liquidity into the system when the system is gasping for air. So the fair question is this: quantitative easing can stop a bad crisis turning into something much worse, but the unfair version is also important. Because where does quantitative easing enter the economy? Not through your payslip, not through a nurse's wages, not through cheaper rent, not through a bag of cash dropped equally on every town in Britain. It enters through the financial markets. It buys bonds from investors. It changes asset prices. It lowers yields. It encourages money to move into other assets. And who owns most financial assets? Not the average worker living month to month. People with pensions benefit indirectly. Some businesses benefit indirectly. Mortgage borrowers may benefit if rates are lower. The wider economy may be supported, but the most direct boost is felt by people and institutions already holding assets. That is why quantitative easing can feel so strange politically. The Bank of England may be trying to save the economy, but the visible effect can look like asset owners being rescued first. Bond prices supported, share prices supported, house prices supported, markets calmed, while ordinary workers are told to wait for the benefits to trickle through the pipes. And we have learned in this series the pipes in Britain are not always pointed at the people doing the work. Now there is another awkward point. When the Bank of England creates reserves to buy gilts, those reserves do not just disappear. They sit in the banking system, and the Bank of England pays interest on many of those reserves. When interest rates are very low, that was not such a huge political issue. But when interest rates rose, the cost of paying interest on reserves became much more noticeable. So the public sees a strange picture. The bank created reserves during quantitative easing, banks hold those reserves, interest rates rise, and now commercial banks receive interest on reserves held at the Bank of England. That does not mean banks simply got handed free money for no reason. The mechanics are more complicated than that. But politically, it is not hard to see why people get angry. Because once again, the money system seems to have a private toll booth inside it. This is where the whole trilogy comes together. Private banks create deposit money when they lend. That often favours people with collateral, especially property. The government creates public debt when it borrows. That debt can fund services and investment, but it also becomes an asset for investors. And the Bank of England creates central bank reserves when it needs to steer or rescue the financial system. That can stabilise the economy, but it often works through asset markets first. So Britain does not have one simple money printer. It has connected machines, a lending machine, a borrowing machine, and a central bank machine. Each machine has a different group standing closest to the output. With private debt, the closest people are approved borrowers, banks, sellers, and asset owners. With public debt, the closest people depend on what the government spends on: wages, services, contracts, benefits, infrastructure, or interest payments. With quantitative easing, the closest people are financial institutions and asset holders. So this is a pretty uncomfortable pattern. Money creation is not just about quantity, it is about entry point. Who gets it first? What do they use it for? What prices does it push up? Who benefits immediately? And who pays later through debt, rent, taxes, inflation, or low public spending? This is why money printing is such a bad phrase. It makes the system sound simpler than it is. It makes people imagine a machine spraying cash randomly into the country, but the real system is more selective, more technical, and much more powerful. The Bank of England does not usually print money into your wallet. It creates reserves in the banking system. Private banks do not wait for money to exist before every loan. They create deposits when they lend. The government does not borrow like a household. It issues promises that become assets for the financial system. And somewhere underneath all of this, ordinary people are still told the same simple story. Work hard, save up, don't borrow too much, pay your bills, be responsible. And that advice is not wrong, but it is incomplete. Because while workers are told to manage money carefully after they receive it, the economy is shaped by institutions that can create, direct and price money before most people ever see it. That is the real money game. Not a giant printer, not a national credit card, not a simple pile of taxpayer cash, but a system of promises. Bank promises, government promises, central bank promises. Some promises become your wages, some become your debts, some become someone else's asset. And once you see that, the question changes. It is not just how much money does Britain have, it is who gets to create it, who gets to own it, who gets paid interest on it, and who spends their life chasing it after it has already moved the price of everything they need. Because if you want to understand why Britain can look rich while so many people feel poor, you have to stop looking for the money printer and start looking at where new money enters the room.